Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we are back with another episode of the Real Estate Investing Club. Today we have Aaron Fragn with us. We don't have a ton of repeat guests, but Aaron is back on to share his energy. I love the energy Aaron brings. So Aaron, thank you very much for hopping on.
Thank you, Gabe. Glad to be back here. I love the show, and a lot of updates since we last came on the show. Probably almost a year and a half ago, I'd say.
Yeah, something like that. It's been a while. During COVID, I remember that.
Oh my gosh. Yeah. Well, real estate values were soaring and we were scared, right? And now real estate values are dropping and we're scared again. Why is the market always scared? Boy.
Seems to be a common theme there.
Yeah.
All right. Well, our format is starting out with stories. I know you've already been here and shared yours, so you don't have to go too deep in it, but just to give the new listeners kind of an overview of how you kind of got started in real estate to begin with.
Sure. So I actually got started as a real estate agent in 2010 and a wholesaler putting signs up on telephone poles to say, "We buy houses," which used to work really well at getting deals. Didn't work anymore, but hey, you know what? If it goes back to a buyer's market, I'm back to the telephone poles on the side there. So
to jump in, I'm just going to give you an aside here. I tried that when I first got into real estate. I tried the trick where you go around, you do the little stapler and you put it on the telephone poles. Yeah. I must have put like 100 and something out there. I didn't get a single freaking call. It was wow. Seattle must not be the market for that, but
it just stopped working around 2016. It really became a seller's market. It worked magic in 2010, 2011 because no one was buying houses. You'd put a listing up and no one would call. It was a terrible market. Yeah. And so I learned how to do short sales. I learned foreclosure properties, REOs. I started meeting investors doing these types of deals and figuring out how to source them and get them from good prices from the banks. Short sales was really my specialty. And at the time, it was very prevalent. So yeah, I put the hustle in, man. I put up the signs and that actually got a ton of business. I made some commissions doing that. I was able to then get into a 6 family with my business partner today, Seth Martinez. And we figured out how to buy, renovate, refinance the property, get back our capital. Then we raised outside capital from people I met at like RIAs. I went speaking at a lot of meetup groups and different real estate networking associations. And I would go and speak there. And that's how I meet my investors and started raising capital. And then we developed a management company, which was extremely difficult. Probably the hardest thing of it all was the management side of the business. And boy, we still are, learning every day with that and hiring better people. And, you got to be slow to hire, fast to fire, as they say in that business. So, but that's really our specialty. That allows us to buy these mismanaged apartment buildings where tenants aren't paying rent, rents are below market value. They need renovations and they're just completely mismanaged. And it's a really heavy lift, but we going with our in-house management company, we produce better results from the property, get better cash flow. And then we try to complete a cash out refinance in about a 3 to 4 year period generally. Yeah.
Perfect. The BRRRR strategy. I love it. That is a classic. And those of you, BRRRR is always associated with single families, but man, you can do that with any real estate out there. The formula is pretty simple. So
well, the BRRRRs actually started in commercial real estate. That's how the billionaires have been building their wealth for years. It's just they never told anyone about it and never gave it a cool name.
They didn't brand it. That was the problem.
Got to brand things, my friend. It's all about branding. Yeah.
Yep, absolutely. So yeah, I mean, you hit kind of a nail on the head there. Management. You built a management company. You said that's the hardest of what you've done, and I totally agree that management is definitely the hardest. Which is why I'm curious. Why did you decide not to stick with third party?
Well, we just did not have success with them. The first one we hired was kind of a smaller company that just, I don't think had the bandwidth to do what we needed to be done. When you're buying a property and the tenants have bad habits, maybe a quarter of them are behind on rent and end up in eviction court. Another quarter may not just be able to pay their rent, want to do cash for keys. Then you have certain tenants that just are going to be non-cooperative or just have bad habits. And, it can be a really heavy lift. It's a ton of management. It's not like buying a turnkey property in a high-end area where everyone pays their rent on time and fixes their problems and doesn't bother you. That's not really how you make your money in this space. You buy a mismanaged building for a discounted price. And that's really where it's made. Now, you can find buildings in certain markets for discounted prices that are actually managed well, but just there's room to increase the rent. But that's really a diamond in the rough. We come across this now and then. But the main bread and butter is finding properties that need all this improved management. And none of the management companies I hired were willing to do as much work as that needs to be done to turn around these buildings, quite frankly. And one of them was taking money from us, meeting tenants of properties, getting the first month's rent and security deposit, and then leasing it up to another person the next day and collecting the money and running off. So, it was really a difficult strategy there. And we realized, listen, if you're going to put your reputation on the line, raise capital, take other people's money and put it to work in real estate, you really need to control the asset very closely, make sure things go exactly according to plan. And as soon as they start to go awry, figure out the problem. Do I need to hire someone else? Do I need to provide a new service provider? What's the problem, right? So that is how we run these buildings very closely, very tightly, and that allows us to get to our refinance position faster, ideally get our cash flow faster. So it's all about management. You can do well in Seattle, you can do well in New Jersey, you can buy hotels or office space or apartment buildings, but if you don't manage it right or have a good plan and execute that plan properly, you're not going to succeed.
Yep. Yeah, second that, man. And I'm not in multifamily, or I guess I'm in mobile home parks, RV parks, and self-storage. And finding good management on those as well is equally as difficult. It's really, once you find someone who really does work out, you got to treat them well, because that's gold right there. So totally get it. Love that you guys are, decided to make your own management company and really take advantage of the ability to control the entire process through. I do want to jump into the market today, because we are at a kind of a unique inflection point right now. And we're starting, everybody's talking about the recession. They're all saying it's going to just take a nosedive, even though we've already seen interest rates rise. And so what are you seeing out there? I'm on self-storage, mobile home RV parks, different side of the spectrum as you're in multifamily. What are you seeing out there on the multifamily side in terms of, seller pricing expectations, buyers out there in the market, all that kind of stuff?
Sure. So yeah, really interesting example. We were in negotiations on a 63 unit in Trenton, New Jersey, and we had agreed on terms with the seller about a month ago and signed an LOI on our end, expecting him to send back a signed LOI. A week later, after shopping around what we had agreed to, he ended up going with a different buyer. And that isn't really good business, but that's unfortunately how business is done. That's why you want to have tight windows of time for the other person to sign your LOI. We gave him probably a little too much time. So fast forward a month later, that buyer didn't perform. Okay. So he's coming back to us now, and there's a situation where the building actually isn't in foreclosure. So it's a little bit of a different scenario, but it's really interesting now. Prices have come down. Then we've lowered our offer by about 5 to 10% now on this property. Interest rates are higher. I'm paying 50 to 100 basis points higher than I was looking at possibly just a month ago, right? And market sentiment is even lesser than it was then as well. So, is that reflective of the entire market on a whole? Probably not. But at least in this transaction, in addition to that, again, there's the foreclosure factor, which is putting a lot of pressure on his end. So prices come down, and that's it. Interest rates go up, prices come down. So when we're bidding on real estate, I'm assuming cap rates are higher in the future, meaning prices kind of remain down, but then eventually come back, right? We have a 15-year projection. I don't assume real estate's in a recession for 15 years. That would be illogical. But I assume inflation stops growing and its roaring rate, which we kind of need it to slow down. And I assume inflation goes back to 2%, which is its 100-year average. And then, that I assume rates are going to go up to like 6.5, maybe, somewhere around there. That's where I'm pricing it at right now, which is a little high. I'm actually getting rates more around 5.5, but even 5 in some cases. So they're not terrible yet, but that is going to change ideally. So, putting all those factors into your spreadsheet, that's how we're underwriting buildings. Higher cap rates, lower inflation, higher interest rates, and then boom, that gives you an offer price. All right. Okay. So now that's it. It's just mathematics, my friend. And if the seller doesn't like the offer, well, tell them to wait 30 days.
Yep. Some sellers and their pricing expectations is it's funny to me. And I apologize to everybody listening. I'm going through a bit of a cold. So it's it's nothing I can do about that, but
no worries.
I'll try to talk normal. So you guys, it sounds like in your when you're doing your underwriting, you're already baking in a higher interest rate. You're baking in a 6.5 interest rate for your underwriting, and that's where you come up with your offer from.
I mean, what we'll do is we'll get a quote, we'll get a real quote, right? Term sheet, and we'll put that in, right? So that's a 5.5, but the guy's like, it could go a little higher by the time you close. Then, so we'll price it out there. So we'll kind of get an average of all three. Like, what's our rate quote right now? What's it likely to be at that time, which no one really knows? Maybe just tack on another like 25 basis points, depending on how quickly you plan on closing. And then, you come up with an average kind of all those numbers, a best case scenario, a worst case scenario, a most likely scenario. And generally, we're going to go with an average of all those. The problem is if you just assume a worst case scenario every single time, you're just never going to get a deal. And there's times I probably assumed too rosy a scenario. And like, I'm still glad I bought the real estate, because years later, even if I paid 5% more or something, but it's gone up 35%, really the grand scheme of things, I'm glad I own the property, so, obviously you never want to overpay. We want to underpay for real estate. You make your money when you buy, but you have
not the end of the world if you don't.
You have to be a little realistic. You can't be like all doom and gloom. So we get an average of 3 and then try to shoot our best shot,
Yep. Yeah. And I do try to keep that in mind. When I make my offers, I always do really aggressive offers. And then, because I want cash flow. I want there to be cash flow day one, because I do not want to have to take, some other money and pay for the mortgage on this property. And so that's kind of how I go about things. But sometimes when we get to a property and it's not exactly what I want, it's not the cap rate that I really want to hit. It's a little bit lower. Then I just try to remember, even if you close on a property, so long as it has a positive cash flow, it's going to be a good deal in 10 years. If you hold it for 10 years, it's going to be a good deal no matter what. Especially just because it's more than just cash flow. You get, you get resale value, you get tax benefits, all that stuff.
Yeah. Also the value add, we look at buildings, rents are 25% below market value. Maybe there's a gym, like where the building we're looking at has his and her locker rooms, 4 saunas, like this beautiful gym, and it's being used to hold construction material for the seller. So, a perfect example of just an underutilized amenity that wouldn't be that expensive to kind of get it back up and running. And then you're going to attract better tenants, be able to charge a higher rent, give your building a whole different feel with an in-building gym. So just a really obvious amenity upgrade that, all we have to do is essentially buy the equipment. It's already built out.
Yep. I love it. I'm actually going through a deal right now, and self-storage, I usually try to buy it at like a $50 to $60 per square foot. We're doing this at I think it's 110 per square foot, but because there's a huge upside, we're giving this guy great price because we know that there's the upside for a build out down the line. It's already permitted. It already has everything ready. So the in-place cap rate sometimes just doesn't matter at all. You just got to look at what the goal that you're trying to achieve. Although that thing that still does have a positive cash flow on close, and that's one of my hard and true. I will not go against that. It has to have a positive cash flow, or I'm not buying it.
You wouldn't like North Jersey then. That's why you do the what's that called? The RV stuff, right? And then that's good cash flow, right? That's like all cash flow, right?
Yeah. Cash flow is pretty good on those.
Yeah.
I know that's not the same with apartments. What's the OpEx that you guys usually run at for apartments? Is that 50-55%?
What was the question?
The operating expense ratio. What does it generally run at for apartment buildings?
Yeah, it depends on the age of the building, the size of the building, but yeah, generally you want to be 40% of your or it really depends, up to 60%, so but yeah, it depends what you're trying to do to the building as well. Sometimes you come into like you're saying, a building and the rents are not that strong, the collections aren't that strong, so it doesn't look that great on paper. But you say, well, wait a minute, the rents are 25% below market value. Oh, there's all these easy to do amenities that are going to even then bring the building up to the next level. So it has even potential beyond that. So Yeah, so it kind of depends on how much of that we're looking at, and that'll affect what our operating expenses, things like that.
Cool. I love it. All right. So what's next for you guys? Are you guys, just trying to do bigger and better for multifamily, or you trying different assets, sticking with multifamily? What's the next step?
So yeah, absolutely. We have a good method here. We have a good management company that is practicing the art of repositioning apartment buildings. We know this market very well. We have a good group of investors here. Our track record's well. So if it ain't broke, don't fix it. There are tons of markets out there so you can build wealth in. But what I've learned, like I said, it's all about your boots on the ground, your infrastructure. So we are really focused on this market. North Jersey here, we are expanding to Central Jersey a little bit. Trenton is an area more in Central Jersey we're looking at. And apartment buildings and mixed use real estate is really where it's at. I still think people are going to need a roof over their head, whether there's a recession or not. Housing prices are going higher. The cost of housing, it's less affordable to own a home now than it really has been in a decade or so. So that's going to push more people to rent. You still need to live somewhere. You still need to have a nice family friendly place, and renting ain't so bad. So that's what a lot of people are going to be doing, I think, in the next few years. And that's going to be good for guys like us that own a lot of apartment buildings or residential housing. So, yeah, definitely going to stay on the business plan here. We're not changing anything. We are looking into ground up development a little bit more. We're developing a couple of duplexes, which is exciting. We'll probably look to develop multifamily housing on a larger scale in the future because they're just not building enough of it. But I also think we want to let prices come down a little bit and kind of let the dust settle on these interest rate hikes, and then start to get into development kind of at the bottom of the buyer's market, snag some land for a good price. And then by the time we're back to a seller's market, have it ready for sale or refinance. And that's our strategy there.
Perfect, man. I love it. Sounds like a very solid business plan to move forward with. And you guys are 100% focused in the Jersey area, right? You guys don't go out of the state?
Yeah, that's right. Because we manage everything in-house. We want to be near our assets. And it's a good market. We work off that New York City metropolitan market, huge demand, so many people living in one place. The rental prices just continue to go up here. The hardest part is finding a good deal. It's a very competitive market.
Yeah, that seems to be the hard part for any of those big markets out there. Yeah, I feel your pain over here on the West Coast too.
Yeah, you just got to be smart. The prices are a little crazy sometimes. Yeah.
Yep, it's all about volume. Keep making those offers. Eventually, you're gonna find something that works. That is my motto. All right, I just checked the clock. Whoop! I cut you off. I was speaking over you. Repeat what you just said.
I was just like, get creative too. Sometimes listen to what the seller needs. Oh, I need you to close in 45 days. All right, cool. Can you hold back $500,000? Maybe I'll pay you 7% interest rate. Ooh, 7%. That's more than I lost in the stock market. So get creative, right? Make the deal work one way or another. And it's not always about the price.
Yes, man. Thank you for saying that. Creative financing is the way to go. We're closing on one right now. We're doing a seller finance note, interest only for 10 years. And it allowed us to go higher on the purchase price, hit his purchase price, just because we only have to pay down that interest. He's happy. He gets that interest payment every month. We're happy. We get to close on a good property. So creative financing, that's where it's at, guys.
Cool. All
right. We move. We just went through our 15-minute mark. So it is time to jump into the quick question round. Are you ready?
Shoot.
Let's do it. Starts with books. I'm a big bookie. I'm a big form of education. So if you could give me 2 recommendations, one for general life wisdom, one for real estate specific.
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Okay. Well, the book that got me into this was Rich Dad Poor Dad. I know everyone probably suggests one, but I got to go back to the basics, man. You know, it's such a good book. And you know what I like about it too? It engages you. It's like easy to read. A lot of these self-help books or guru books or like real estate investing books don't honestly keep my attention. So I never finish them. So that's why I'm not suggesting them. Right. So a good book kind of gets you to finish it. And that's why, so that's another thing too. But I'm sure there's more analytical, better books out there than that. But
no, like that's a classic. I love it.
Yeah.
That's how I got started too. And you're right. I think it's like 200 something pages. It's like, and it's big font. It's totally easy to read. So
it's like a 2-day read. It's easy peasy.
Yeah.
So personal book, maybe like Zen and the Art of Motorcycle Maintenance. First of all, because I like motorcycles and they have like kind of like travel around. It's a fun story, but also it talks about quality in it. It is a bit of a dry book. Sometimes it's kind of hard to get through, but for the most part, it's really interesting how they break into defining what quality is. And it's, running a small business, right? Me and you both know every day we talk about quality. What is it? Should I put 6 hours into perfecting this, or, is it more important I'm doing this, or, what's the most important thing? So we put our quality in everything. What is quality? How do we analyze how to put that time into things? So really interesting book, and talks about life like in general. So Zen and the Art of Motorcycle Maintenance. Yeah.
Cool. Is that the one? Is that about the guy who did the motorcycle trip from like Canada to South America or something like that, or is that something else?
I think that's something else.
Gotcha. Okay.
Yeah.
Sounds like a good book. I haven't read it yet. I'll have to pick it up.
It's like from the 70s. It's kind of an old one. Yeah.
Nice, man. Wisdom doesn't change over the years, so that sounds good to me.
Right. Yeah.
All right, moving on. This one is for your younger self. So if you could go back to the Aaron who had no experience in real estate, go to him, look him in the eye, give him one piece of advice moving forward.
Don't invest in cryptocurrency.
Yep.
You idiot. You freaking idiot. Outside of cryptocurrency, not taking that into account, my advice would be stick a little more to your business model. I've done a lot of things in real estate, which I think is one of the reasons people do invest in me. But at the same time, if I just stuck to having a real estate fund, buying apartment buildings, developing a good management company, kind of just had a really good business plan from the start and stuck to it, I think we would be further along in that space. For many years, we flipped houses, we wholesaled houses. I got into coaching a little bit, so kind of put my resources in a lot of different parts of real estate, which is good. Now I know how to do all these different things, short sales. So, but at the end of the day, I built a realtor team, a lot of fun stuff. I maybe would have just focused more on real estate syndication, running a good fund. It was less competitive back then, although I had less experience and everything. Just learning how to raise capital would have been good, taking a course on that or something. And boy, if I had really focused on the fund in like 2013, when we first incorporated, there was less competition, better deals, and I probably could have done well with that, I'd say. Yeah.
Yep. Yeah. I like that advice is just once you find something, just stick that path, stick the course, because quality comes from repetition. Quality comes from doing the same thing over and over again. If you choose one path, stick on it, because that is going to get you to where you want to go.
Yeah. Yeah. Mm-hmm.
All right. Next question. This one is habits. They form the foundation of our life. So if you could point to one thing you do day in and day out, you feel contributes the most to your overall health, well-being, and happiness, what would that be?
I'd say exercise. Yeah, I've started exercising almost every day now for at least 30 minutes to an hour, and it's been great. I've always been a little thicker, so I feel good. I'm losing weight, feeling better. I also like to ride my dirt bike and ATV on the weekends. Sometimes I do hair scramble races. So I'm a big off-road guy there, and you need to be in shape for that stuff. It's pretty intense workout, especially if you're doing the races. So I love exercising and eating right. Yeah.
Perfect, man. I love it. Dirt bikes though, right on. I'm 35 now, and I'm not old. I'm not going to say I'm old, but I feel my body getting to the point where like, dude, if you fall right now, you're going to break every bone in your body. Don't do it.
You got to learn how to fall. You got to learn how to fall. That's
more power to you. All All right. And that leads us to the very last question. This one's for the listeners. You've given us a lot of good advice, so I'm sure people want to reach out. What's the best way for them to do that?
Sure. So our website is peoplescapitalgroup.com. We do weekly blogs, weekly podcasts, webinars almost every week as well. So tons of content there, educational videos. And you'll also be able to then sign up on our real estate syndication pro site there as well. You can get into our back office, create an account, take a look at past offerings we've done and how our investor pool has fared in the past there, historical performance, and even stuff we have coming up as well, and a scheduled discovery call. And so we run a 506B, so we do need to connect on a discovery call and kind of learn about your investment goals. But that's always a great opportunity for me to educate people and to learn more about them as well. And but yeah, peoplescapitalgroup.com is where it all starts. You can learn a ton of information about just real estate investing in general and our fund as well. Yeah.
Perfect. Peoplescapitalgroup.com. I'll put that in the show notes. So if y'all want to reach out to Aaron and learn a little bit more about what they're doing out there in Jersey, go ahead and click a little more in the description. It'll pull down the full description. In there, you can find Aaron's URL. So Aaron, that wraps it up. Thank you very much for hopping back on the show.
Thanks, Gabe. Have a good time as usual here. You enjoy your Friday and stay out of trouble.
All right. And for everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. Other than that, this is July 1st. So this is the 4th of July weekend. You guys have an absolutely fantastic weekend. And I look forward to seeing you on the next episode.
Thank you for joining us for another episode of the Real Estate Investing Club. I hope you guys enjoyed the episode and were able to pull some actionable advice that you can go home with and apply to your own investing business. Before you go, I have a gift for you. If you're a new investor looking to get started or an established investor looking to take your business to the next level, I've created an ebook just for you available on the website. This ebook will cover how I was able to create both active and passive income in real estate with very little money to start with. In it, I will address the 3 most often cited obstacles new and veteran investors run into by showing you how to find a deal that's actually a deal, how to finance that deal with little to no money down, and how to exit a deal for maximum value. And if you get the ebook today, I'm going to bury you in bonuses, 7 of them to be exact. First, you'll get the off-market lead generation blueprint, which will take you through the exact systems and processes we use to generate off-market leads like clockwork, which is the most important skill when it comes to creating real wealth in real estate. Then you'll get the A to Z REI systems and vendors guide, which will allow you to peek under the hood of our business and see the exact tools and systems and even the vendors we use to grow our business. After that, you will get the top 100 best performing keywords pack, which will give you the exact keywords we use to target leads online and generate leads without having to lift a finger. Next, you'll get the contracts bundle for wholesaling and renting real estate, which will give you access to all of the contracts we use in the field to execute all types of transactions. After that, you'll get the Investor's Quick Analysis Calculator and Offer Tool, which will allow you to quickly calculate whether a deal is an actual deal and will allow you to create an offer automagically from those calculations. Next up, we'll give you the Investor's Daily Success Tracker, which is a tracker you can use to ensure you are taking the right actions day in and day out to reach your financial goals in real estate. And finally, you will get the Wholesaler's Template for Quick Assignment Cash, which will give you the templates we use to present our wholesale deals professionally and efficiently to our buyers. I know that is a ton of things to say. I'm glad you were able to stick with it. So you'll get both the ebook and all of those 7 free bonuses when you download the ebook today. All we charge is the admin cost to run the show. So if you are interested in the ebook and the bonus bundle, head on over to the website at therealestateinvestingclub.com. Click on Get the Ebook Bundle at the top of the page and take advantage of that deal. With that housekeeping item covered, I hope you have an absolutely fantastic day and even better week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.